Hi, how are you? Okay, today I think we just wanted to talk about a continuation of our last episode, right? About looking for great stock picking skills that actually um, can give us whereby the companies are healthy and generate good cash flow, either already profitable or working towards profitability break even in the near future quarters, like the next or the next two to three quarters. Um, as I mentioned before, the Russell stocks, mostly they are startups. They were like Microsoft and um, Google way back in the year 2000, and then of course looking forward 23 years later, they are considered like big tech. So as you can see, US is definitely the market leader in terms of technology, whether it's in the form of like uh, making up a moat on platform or on advertising online or providing a software and all that. So of course, um, in the year 2020 and 2021, there's a lot of spec listing as well. So instead of like buying into startup that's not listed, they created all those startup to become listed in the Nasdaq under the Russell Index, or some may not be even qualified under the Russell's Index. They could be crypto miner, could be online insurer like Lemonade. Crypto miner could be like Clean Spark, Marathon, and all that. So, so definitely the first criteria to look for is to look for company that have like little to zero debts. That's very important. Um, in fact, there are quite a lot of companies like that, like Nano Dimensions, NNDM, where something called 3D printing. They have a contract with NASA to have a small, very expensive machine, precision type of printing machine, where they could make chips or any type of like parts, ready in no time, just to put in the plan and the ink, and they can come out. It's some considered like revolutionary product as well. But they haven't actually had good sales, for example. So their price to sales ratio are very high, or definitely, they have not actually scaled or have not even gone into production. So even they have zero debt and a lot of cash, this is just one of the criteria that we need to look for, must together with other things as well. Number two is there are very little chance for that company to have the need to raise funds in the next few quarters, i.e., for purpose of setting up a factory. Like some EV companies that are conceptually seems to be doing quite well, like Canoe, or the company that makes electric bikes or something. I can't remember the name, but they probably have like 100 200 million dollars cash in their account, but they probably would need like 500 6 million to scale up a manufacturing plant. So dilution will happen. And the third factor is to look into a situation whereby what are the likelihood of them going bankrupt. In situation like that, if you have continuous burning rate or high operational costs, like high software engineers, and you're not taking initiative to retrench or scale down or to start to get sales, whichever way lah, both also have to go in tandem, then you might go bankrupt like Carvana and all that. But of course, Carvana is a very interesting story lah. The shares was hammered, and then of course they found an investor. It went all the way up. It's just a company that sells car, but the way they do it is online and bidding and all that kind of stuff. So then, of course, another thing is they must have a moat, a market leader. You get like Seam Limited, considered would be a market leader in Southeast Asia. You may have like some South American company like New Holdings or Stone Cold, also a fintech that has a monopoly in Singapore, and they have actual users, buying, using the product or using the services. Then yeah, it is one thing to look into. Some may still may not have so much cash left, but they have a lot of sales, So, but those sales are not capital in nature. Basically, they are just like holding on trust for like fintech. Let's say there could be people depositing $100 all the time, but they only spend like 10 to 20. So there's always like extra funds there, but they can only use it for to get short-term interest. So the next one is the revenue has should be in double digits. It means their revenue quarter to quarter or year to year should be in double digits, high double digits, 20%, 30% growth. So even though some companies they may have high price to sales ratio, it may still justify because if the price if the sales keep going up, then of course the price to sales ratio becomes lower. That makes the company even more attractive. But some stocks may have already high to price to sales ratio, like Innovix, for example, revolutionary battery maker for mobile phones, and apparently can do like 4,000 hours in one charge for headphones and all that. Really good for like those virtual glasses, like what Vision Pro or the Quest by Facebook. Um, it may they may have already a very high price of sales, but of course then you must have the faith, or do enough research to see that okay, this actual product really is revolutionary, and they have the patents and all that to be able to scale productions, and they are already in probably production line 1 and all that. They are working towards production 2 or line 2 and all that, which is maybe something like what Tesla was like in year 2018. Then of course, number 6 would be, of course, if you can find a growth stocks that is growing 20 over percent or 30 over percent per annum, at the same time is making a profit like Palantir, then that makes it even more worthwhile, plus zero debt. Whether um, Fed goes up interest rate to 10% or 15%, it doesn't affect them. Business goes on. And if they have a moat, means there's no competitor. Like Palantir is working with helping Ukraine to fight a war, for military, for all the big health association, like the American Health Association. I can't remember the actual name. NHS, National Health Service in UK, where to predict have all this data collection plus AI as well, able to come up with certain decision as to where a pandemic might happen again. So these are like considered a necessity, and there will always be a market for people spending this kind of money. Then of course, then you got the next company, which would be like Grab, for example. They are working towards breaking even. That's why a lot of people always wonder, all these software company, they use platform to make money, and they only have staff and office rental and all that. Why why they have so much difficulty making money, making profit? But I believe that the time is probably now and onwards in the near future. Grab is one of them, saying that they are going to make profit. Well, as you can see, Sea Limited in Southeast Asia broke even last quarter, so that's why the share jumped. And then, of course, the next one is number 8 would be looking for software company. They always have this issue, which is stock-based compensation to their engineers and their shareholders, because they come with a low pay and they want to reward them if some software are working well and we are able to sell and able to scale. So like, for example, Salesforce, which is one of the few software company that have broke even and making money, and they have high stock-based compensation. Palantir used to have, but has reduced, because it's definitely affect their bottom line. So these are the 8 factors that you need to look for when you want to review a company and to build your conviction towards investing in a company. So I hope you like the channel and this video, and is educational for you. Keep in touch, and do comment if you have any points you want to bring forward. Thanks a lot.